Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seymour interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seymour.
Welcome everybody back. Another episode of the Apartment Guys coming at you. And it's the Apartment Dudes today, hanging out with my friend Stefan. Stefan, I don't want to butcher your last name. I've tried to say it before. Will you say your last name for us so I don't get it wrong?
Tsvetkov, Tate.
Tsvetkov. Thank you. Tsvetkov. Stefan Tsvetkov, guys. And Stefan is a data guy. He's a data analytics driven guy and also a multifamily investor. So I think he's going to be able to really bring in some good kind of meat and potatoes sort of knowledge for us as listeners and help us understand valuation and in particular market analytics and property valuation from a data analytics standpoint. So Stefan, welcome to the show, man. I'm really glad to have you. Thank you for having me, Tate. It's my pleasure. You're welcome. Yeah. So before we get really, into the good stuff, tell us a little bit about you. And I know that you're in New York City now. Tell us a little bit about maybe your background and kind of how you got to where you are today doing what you're doing.
Mm-hmm. Like you mentioned, I'm in New York City. I have a previous career in financial engineering. So I come from a finance background, and I'm currently a multifamily investor here in the New York City area, like New York, New Jersey states. Primarily flips, obviously, as you know, many of your commercial multifamily listeners know, these are not, as strong markets for buy and hold. So that's what I've been focusing on. Originally, I'm Eastern European. I came here for my master's. I went to Columbia University in New York for financial engineering. Then I worked for 10 years in finance. I used to manage large derivatives book with a team of a few other people. And I decided to move on to my own investment career.
Awesome. So tell us a little bit about what you do now, like your kind of your day-to-day, doing your own thing. What's your day-to-day look like?
Mm-hmm. So honestly, my day-to-day is a lot of coding and stuff. So ends up kind of like technical and like underwriting deals and looking for deals, studying markets, writing a lot of Python scripts to do that. And I host a webinar as well. I talk to other investors like in the commercial and residential space. So my day-to-day is I try to build systems build my online systems, build my data analytics and systems to be able to find like more and better deals. And that's pretty much what I'm focused on.
Mm-hmm. Mm-hmm. Cool. So you're kind of, and tell us a little bit about RealtyQuant. So Stefan's company is called RealtyQuant, as in quantify, QUANT, and you can find RealtyQuant at www.realtyquant.com. I know that you guys are a data-driven and qualitative kind of analysis company in real estate, but tell us a little bit about what you guys do with RealtyQuant.
Yes, so RealtyQuant is a mission, I would say. So the mission is to kind of assist the real estate industry in like using more like data science and quantitative techniques, and so that's like the primary purpose. I teach a course on data-driven investing. We have a course starting in January. We also have market data and some other things as well. So what is data-driven investing, and like specifically like to RealtyQuant, for example? So To some of your audience, what this means, and it's really both commercial and residential investing that it applies to. So it really means one thing is automated underwriting. So if it's either on market or off market listings or data, it's the key is kind of to have it end-to-end automated. So if you're having commercial multifamily buildings, it really means, okay, pull the inventory of all buildings in given markets, study them, sort of preliminary, have a kind of sort of preliminary income expense sheet analysis, if you will, because you're not going to have the actual income expense sheet. You're not going to be able to assess, okay, what's going to be the value add, like how much equity gain am I going to have on this building easily, but you can do it in a preliminary sense. One approach to this is looking at like rental listings for apartment buildings. So that can give a lot of insight into, where their rent levels are, where their, like pet fees, administrative fees, things like that are, like various income and expense utilities, income and expense components, and trying to kind of model the potential value add that those commercial assets, and that can be anything, can be a 5-unit building, can be a 200-unit building, and it doesn't really matter. It's as long as it has the similar like valuation approach, and like just the commercial valuation. So that's one approach to like automated underwriting in commercial space. In residential space would be, okay, pulling like tons of listings. I would say they can be even on market, because that, and kind of like finding like the tail of the distribution, like the 0.1% or something like that are like mispriced. So running automated valuation models is another useful technique. Now that's challenging, as Zillow recently learned with their iBuyer business. That kind of went down. But it's running automated valuation on properties. So that's in data science, that's done via typically like a method called like gradient boosting regression. It's not that complex. It's just like sort of a non-linear technique to kind of being able to capture things like location, because like real estate is driven by location. So location is a big factor. So how do you capture it? You use that. And so that's like having automated valuation can help discover inefficiencies in the real estate market. And it's really like, my view is, okay, to look at it like a trading, it's just like trading the real estate market. And, how can you find more inefficiencies? How can you do it more in a better way with more data, etc. So another thing on data-driven investing is to the automated underwriting component is, well, condition scoring. Condition scoring is a big component. Some of your audience, they can look up, there is a company in New York actually called Foxy AI. I'm not associated with them in any way.
What are they called again? Can you say that again?
Like Foxy, like a fox, Foxy AI. Yep. So they, that's one company that they do condition scoring for real estate images. So for property images. So, I mean, just, it's challenging. It takes like a lot of, kind of computational power if you want to underwrite thousands of properties, especially, or something like that, right? But again, like this is a main element that is holding us from having automated underwriting, in a sense of, being able to underwrite like thousands of buildings or something like that without, in a preliminary way. And then of course, like, one should properly be doubtful of some of that, and then like, do his human analysis later. But it's still very useful when you want to preliminarily analyze multiple buildings. So that's another, and like natural language processing on that. If one wants to read descriptions of properties, let's say property descriptions, try to gauge, are they in, average condition, and excellent condition, or poor condition, things like that, give some kind of scoring to it. That's another useful thing. So those are some data-driven applications. But I guess just for for your audience, one thing I would say is, in my opinion, not data-driven is, kind of, if you read a Marcus and Millichap report, okay, so the report itself is data-driven, but are you going to get intuition with the data? Are you going to feel it, sense it? Are you going to inform your business decisions necessarily easily? Not really. The truth is, and because we ourselves, like my company, we issue market data, and the truth is to really understand and kind of urge people to kind of build their own models and have that and down the road, even if initially they use something to kind of speed on their process or outsource, etc. But I just feel like it's hard to build intuition without actually looking at the real data. So that's that's another thing. And
Good stuff, man. You guys are really kind of all over it in terms of the data driven aspect of this. And really the only other person that I know in this space that speaks to data and the importance of analytics at this level is Neil Bawa. I don't know if you're familiar with Neil or not, but he's
I know Neil.
Yeah.
He was at my webinar a couple of weeks ago, actually.
He was at your wedding?
It's my awesome. webinar, not my
webinar. Okay. He was at your webinar. Yeah, no, he is a great guy. And yeah, we affectionately call him the mad scientist of multifamily. And I'll be honest, he's been on my podcast. His partner Anna's been on my podcast, and I've listened to him a lot. But beyond that, I don't have a whole lot of experience with kind of deep dive data analytics. And we have at Greenlight, as many of the listeners know, we've really honed in on the Columbus, Ohio market, where I actually am right now on location broadcasting from, and also the Oklahoma City markets and all the tertiary markets around those. And I guess, for us, it was a matter of a lot of different things. In the case of Columbus, I'm from Ohio and have connections and resources here and familiarity, but also the metrics of Columbus. It was one of those markets that people like Neil continually mention because of the uniqueness of the employment metrics, the economic metrics, some of the intangibles, the cultural stuff. So, for us, it was a natural fit for us to go after. And then my partner, Chelsea Garber, has had a ton of time and experience in the Oklahoma City market. And we also like those metrics there. There's a lot of inventory in the kind of Class C property range and lots of stuff that needs to be fixed up. And so for us, it was pretty easy for us to hone in on those two markets. But beyond that, I guess we haven't really employed data to a level that I would say is, powerful and maybe applicable. So what recommendations might you have for someone like us, a company like ours? We're not necessarily looking to expand into other markets at this point because our deal flow is pretty good in these two markets.
Right.
We don't have anything under contract currently right now, but at the same time, as you know how it is, Stefan, as you get to know these markets well, you just kind of tend to want to continue to invest in those specific markets. So
right.
What thoughts do you have on how can a company like mine be best employing some of the things that you offer?
Yes. So that's a good question. So for example, I would say, because you're saying you guys focus on Columbus, Ohio, and your partner had previously and currently focused on Oklahoma City as well, right? And so let's say it's a little bit interesting to think about it because to your point, real estate is a physical asset and there's a lot of building up your network in place and building up your property managers, agents, etc. in a given market, right? So it's a little bit challenging to do it in a truly data-driven way, more globally. But one thing you can do is if you take a resource like apartments, CoStarsApartments.com. So they have the inventory of their buildings there. Yeah. And if you take, so that inventory you can purchase, besides CoStar, you can purchase from Prospect Now, you can purchase from other sources. But if you consider that besides that sheer stock of inventory, there is also rental listings that they have. Now that becomes more powerful. And that's to my previous comment, that means you can actually study value add for commercial assets in a scalable way across thousands or tens of thousands of properties. And that will be in a very preliminary sense, but you can discover buildings that have rents below market by simply combining inventory data that is already available and used by multifamily syndicators, like I know, like we have Prospect Now, etc., but combining it with some of rental listing insights and running some calculations on that and getting to essentially preliminarily underwrite those assets. And that can be powerful because, okay, if you have Columbus, but now Ohio has, X number of counties, let's say, and you can look up a few other counties that have similar metrics, having their buildings inventory, you might find similarities and find, potential other counties that have a comparative. I know Columbus is an extremely outstanding market within Ohio State, and it's different than everything else. But sort of comparable or useful markets that one can invest in, and then one can do, let's say, multiple counties and pick the best buildings in them, even, or the best. Do it not just by region, but also by the quality of the assets themselves, and then across regions. That's potentially, there are challenges to that, since one still needs to build his, maybe if it's vertical integration or property management, there are things like that. But this is one thing that's useful. Another thing, and it's very important right now. So I speak on data-driven investing, but I feel what is actually important to speak about now is that it looks like some of US real estate in the second quarter and third quarter of this year, for the first time, started entering a quote-unquote bubble. So that's at least my metrics, and everybody has a different perspective, but so that's another thing to think about. So is downside risk. So when, for example, a multifamily syndicator picks his markets according to job growth, population growth, things like that, right? Income growth, and picks his market, and this is the best and strongest market. The best and strongest markets are not the strongest ones on the downside. So real estate as an asset has a different downside dynamic than the stock market. Let's say I come from a stock market kind of background, but if you look at really cheap, undesired stocks, like the term penny stocks, let's say, right? They may have very high downside exposure. That's not the case in real estate, where in real estate, the cheap, undesired markets, or if we speak high-level states, if we take the poor states of, West Virginia and Mississippi and Alabama, there is some investor demand in Alabama, but high-level, less desirable locations. So they actually typically end up having less downside risk, because people don't just sell their house at a, and of course in commercial assets, it's a different valuation. One will say, okay, what is the correlation between residential and commercial and so forth? And that's a separate discussion, but still it's fundamentally the same asset. It's driven by, has the same customer base in spite of the different valuation method. And so that is a downside risk is important. So I've been running been urging investors to use market valuation metrics in their approach, because everybody knows property side well, and invests the Warren Buffett way on the property side. So on the property side, people find undervalued assets, they find assets that have value add, they feel it's done really, really well. Now, what's not done the call it Warren Buffett ways on the market side, they don't know if their market is overvalued, undervalued, fairly valued. They don't know where it is. For example, I'm in New Jersey and New York. Investors all the time, for many years would say, the market is overvalued. The market in New Jersey is not overvalued. In fact, it kept being undervalued until this point, broadly speaking, the state level, because as we know, Northeast is undesirable this market cycle. Everybody wants to invest in Florida, Texas, etc. For obvious reasons. And so it's not overvalued, and so that's something. So just to not take too long. So valuation metrics kind of jumped a lot in the second quarter. I was surprised myself. So they went from previously, and to clarify what the approach is. So I use a simple measure for valuation, which is affordability deviations versus a moving average window. So when one does affordability, like for your to clarify, just price to income ratios, but price to income ratio deviation versus a moving average window, what it ends up doing is that moving average shifts up with housing shortage, like population to housing supply changes. As it shifts up, inherently, when you take this kind of difference variable, it's not that price to income ratios predict anything, they don't. But when you take this kind of difference variable on this against this moving average window, it ends up factoring in other fundamental factors like housing supply and population shifts. And so, for example, if San Francisco shifts from an affordability of 6 in the many years ago to maybe like 20 now, like where let's say home prices will be 20 times income, this kind of gradual shifting that happens due to housing shortage in large cities, for example, gets factored in. And so using this methodology, like at the end of 2020, so we're already well into COVID. There was a very short timed recession that was declared in the first or second in April, I believe, in April of the year, and then kind of disappeared, right? Mm-hmm. And then things went up with inflation and etc. But that at the end of 2020, the market, U.S. real estate was fairly valued, and they're broadly speaking. And I was going on some events and I was saying U.S. real estate is fairly valued. Now, there are economists, there's an economist at Bloomberg Economics called Neeraj Shah. So he publishes studies on different countries. He was showing in his metrics, US real estate is fairly valued. Other countries like Canada, countries in Scandinavia, for example, Sweden, and also in also Australia, New Zealand, and a little bit UK, the United Kingdom were showing as overvalued significantly, like in the Canadian market to a big extent. But US real estate, nevertheless, fairly valued. So that was the narrative until end of 2020. Until at the moment, the second quarter of this year came in, the data for the second quarter, and it dependent on data source, can be second or third quarter. There's a little bit of lag, maybe in one of the sources, etc. But at that point, it seems that this regime shifted. So this, where at the end of 2020, we had a single overvalued state of Idaho. So the state of Idaho was showing up as 25% or strongly overvalued, 25% overvalued. And then there were, like some of the other, let me just share the numbers for a moment. And I would
think Utah would be up there. Yeah,
exactly. Yes. So
being right next door to Idaho.
Yep, Idaho the only sharply, and from there, Utah, Nevada, Arizona, Colorado, Texas, Washington, but kind of very mildly. So let's say the states of Florida and Texas, they were staying in a range of 8 to 10% positive valuation, kind of slightly overvalued for 4 years. Because when you run this thing, it's not just, you're kind of like, like you're being negative on the market or something. You just have a constant measure of downside risk that you kind of keep following. And it's useful, so the states of Florida and Texas, they were in the 8 to 10% range, and in the second quarter of this year they doubled. So that's to me is like a sharp kind of negative signal. So what happened is that it looks like the extremely high inflation is already coming to a point where it's exceeding wage inflation. I mean, if we take an example of Arizona, the state of Arizona. And, we all heard about Phoenix where, rents increased by like 20% or something, right? Year over year. And so, the prices statewide in FHFA, like Federal Housing Finance Agency data, increased in the first half of the year, 17%. Incomes increased 1%.
Yeah.
So there is that could be a short-term dislocation. So I am actually kind of hoping that maybe a little bit settles down and things get more moderate with maybe wage inflation picking up or something. But the situation is that where US real estate continued being fairly valued by the end of 2020, it seems it's no longer the case. So currently Idaho jumped from 25 to 48% overvalued in true bubble territory. And then Arizona 32%, Nevada 29%, Utah 28%, Colorado 22%. And the states of Florida and Texas jumped to like 19 and 20% up from their previous 8 to 10% level. Why this matters? Just to give a perspective, this metric prior to 2007 correlated to the subsequent downturns at the state level. And I have the same thing for 2,700 US counties. But at the state level, it correlated to subsequent downturns 87%. So 87% Pearson correlation between the metric, which is simple metric of affordability deviations against the moving average window at the peak in each market, against the drop that happened afterwards, where that drop may happen slowly. It can be like bleeding. On average, it took about 4 years to reach the bottom. So this kind of bleeding down, that happened in different markets, and obviously a sharper downturn at the beginning, so was 87% correlated at the state level and less at the county level. It's much harder to predict smaller jobs. So the county level was like 75. Wow. So it looks way worse. It's harder to predict. But guess what? If one takes the very fundamentals of how you predict like markets to invest in, and you look at population growth. I know investors like to look at, let's say, population growth. How much does it correlate to prices? 40%. So 87% is extremely strong at predicting downside. What is the reason for this? This is not like some kind of magic or like fortune telling or something. It's simply because real estate is a fundamental asset. We know if we take like somebody again like Warren Buffett, how he made money in the 70s or 80s or etc. And if you take like very fundamental stocks like utility stocks, these kind of principles apply. Now in the stock market, it's no longer doable because, as we know, like stock market is driven by the top 5 big technology stocks to a large extent. It changes, right? And so it gets how do you value Tesla, right? Nobody knows the valuation of Tesla, so that's why it's challenging there. But in real estate, we have this incredible opportunity that, one, we know property valuation because they're appraisers, they assess assets. We can find undervalued assets. 2, we can know market valuation approximately. We can we can know which markets are undervalued, overvalued, etc. And just to kind of finish on this. So what was interesting in during global financial crisis, another thing like I just want to share for your audience is that states that were undervalued, for example, Texas at the time was undervalued 5% in this measure. So there were about 10 states that were undervalued. So negative valuation. So those states, the drop that happened was actually tiny. So most people don't know this. Like it's just the assumption is okay, real estate everywhere dropped. It's not true. In states that are undervalued, the average decline at the state level was only 4%. 4% was also the median income drop in the US at the time. Oh, wow. So one can say, that high level in valuation terms, they did not drop. So it means, okay, they just dropped by income, valuation stayed the same. Right. So this kind of, this thing has been very interesting to me. And I did this study at the beginning of COVID first. I wanted to know if I can have continuity, if I can invest comfortably without, because people say, okay, you can take your assets is undervalued, so you can stomach some of the market downside if it happens, right? In a way, given you're purchasing undervalued assets or cash flowing assets, etc. But it's still a component of total return. You don't want the market to turn against you and wipe out all your labor for finding your great deal, let's say, right? And so it's so that was kind of the motivation at the time. And I was very happy to find that, okay, it's, there are things that work and but unfortunately, it looks like this year, things are going a little bit in bubble territory. I was hoping it's gonna take longer myself. As an investor, I myself want to look into more like out of state assets, and for my own investment, I would kind of personally stay away from Florida and Texas and some of those markets for the time, like some mid-range, some of those states, not marketed, broadly speaking markets within them.
Are there, in your opinion right now, is there such a thing as an undervalued market in this environment?
Yeah, there are definitely. So undervalued, now you have to keep in mind that they tend to be also depressed. So let's say valuation metrics, they don't correlate well with appreciation afterwards. For example, let's say after they're downside risk measure, really. This is what I find or believe, because after, let's say, for example, the crash during the global financial crisis, things hit a bottom. So as they hit a bottom, some of the states or counties, markets, etc., went actually in undervalued territory, not just to fall to fairly valued, but fell to undervalued. So as they fell to undervalued, it became that, okay, we can maybe think that those markets are going to perform better afterwards. I believe I saw like 12% correlation, it's really low. So it wasn't like, it's not predictive. But so they undervalued, is we're just speaking of states here because it's like simpler. And I'm actually going to give some cities examples, but yeah, so undervalued states right now, the most undervalued state is the state of Illinois, 14% in this measure at least, 14% undervalued. And then there's like Louisiana, North Dakota, Connecticut, Mississippi, West Virginia, Arkansas, New York, and New Jersey at -1%. So it's really, really kind of maybe lower income states and and the Mid East, like Northeast and Midwest, or what is the term? So those are
northern Midwest area, that North Dakota area and whatnot. Yeah, gotcha.
Right, but North Dakota has performed well, though, interestingly enough, and it's still undervalued. So North Dakota is a very good market. A very good state.
Do you worry about a place like North Dakota as far as it being too dependent on one industry, in that case, oil and natural gas?
Well, that already is a separate. Yeah, that's always kind of concern. That's like the Texas had like an oil crisis, was in the 80s or something, right? And the real estate dropped. That kind of thing is really hard to model, and it's one can always get hit by something like that, like dislocation of this sort. And of course, an overly dependent economy is a downside. Maybe a little less so to something like real estate, but still, I guess Texas served a good example of that in the past. But those are undervalued states. They're just most of them are depressed. I mean, the states of Indiana and Kentucky were undervalued until now, this sudden spike, but maybe wages will catch up a little bit. And so they were like, if you take something like Indiana and Ohio was undervalued as well. So really, if you take something like Indiana or Ohio, they were definitely places that seemed somewhat immune to a drop to an extent. They kind of spiked a little bit to like kind of fairly valued range. But it's pretty challenging to pick. I would probably go with Indiana. I would say it's not as far as undervalued. So it's kind of being fairly valued is not like too big downside risk protection, I feel, because if it's fairly valued, it can still like drop like 10% or something, which is, you're levered. You have like an expensive asset, let's say it's a commercial operator, assume with this assumption. And so it's then, it's a significant risk still. I mean, I don't know. Before 2007, things went between 2003 and 2005. Some of these metrics spiked significantly to a point that was visible. And there was Ingo Windsor. So Neil Bauer, because you mentioned Neil Bauer, he uses, for some of his market data, he uses Local Market Monitor. So it's a company out in Massachusetts. So Local Market Monitor is run by Ingo Windsor, who was on CNN Money before 2007 and was talking that certain markets in California and Florida, et cetera, are dangerously overvalued. So he was talking this thing for like several years. And so between 2003 and 2005, kind of the COVID bubble developed, and then it popped in 2007. So I mean, I have no information for timing or anything. It's just, I'm just kind of doing my duty as an investor, kind of analyst in a way, to share this. I'm not happy about it myself. I was hoping things were going to stay fairly valued and have more opportunities as far as investing in trendy, cool markets and so forth. It seems I might have to wait until the next cycle.
Okay. So, okay. So it occurs to me that we're in an environment now that, basically the last 2 years, it's been anybody's guess as to how things were going to go. I mean, obviously the beginning of COVID, the fear response in the markets and in lending and everything else, everybody thought the market was going to fall apart, or potentially valuations were going to fall apart and go down. Obviously the exact opposite of that has happened, largely in most markets, most areas. And now we've got this huge variable of inflation, and this massive amount more supply of currency and the US dollar. And so it seems to me like we're in one of these really crazy is overused, but kind of a crazy time that having a really solid sense of your data is probably more important now than it ever has been. Would you agree with that?
I would. Yes, I would agree with that. I would agree that at the beginning of a market cycle, it's, not so much necessary, as far as, especially downside risk is practically irrelevant.
Sure.
And so if you take, you still need to look at your job growth and things like that, in different markets, but it's definitely simpler then. And yeah, I would agree it's more important now, for sure. Even until last year, it was not important. Yeah. Even until last year, you don't need to know downside risk too much. And well, given that it was good now, if it and it wasn't, so and it's going to be more and more important. And it's just that if you look at, for example, I'm on LinkedIn a lot, and let's say I see a lot of, when people post things like inflation is good for hard assets, right? And I agree, that's true. So real estate, obviously we saw, that's why, like I mentioned, in Arizona, prices are up 17% for just half a year. So in that sense, but does not mean it's good, so to say, because you don't know the inflation of fundamentals or how they're developing simultaneously. And so it may end up bad, actually, for investors, because what happens is that here, if in the current setting, it led Arizona to enter an overvalued region, significantly, to basically double in its overvaluation, from 15% up to 32%. And that's inflation for you, So it's not really. So that actually, in this case, makes it, just because wage inflation is too much behind. So yes, inflation is good for hard assets, but hard assets are still driven by fundamentals. And if those fundamentals don't experience the same inflation or don't, move accordingly, at some point, this is going to end. And I had one of my undergrad professor who did a lecture on historical inflationary cycles, how they end. And I'm no expert on this by any means, but he was saying that, the final stage of inflation, which could be, let's say, if we're here now, it could take 5 to 8 years ahead, even. There's no timing prediction. Sure. So it can take a while. But the final stage of inflation is actually kind of low income to middle income people going out in the streets and, overturning the government. So that's the kind of the inflation is how it ends. And the reason why that happens is because in the further stages of inflation, wages get to lag too much behind, all the goods inflation, all the food costs and supplies costs, etc. And so wages get to lag at some point, and that causes an issue. And I believe it's gonna be like that for real estate. So it's like if you're a trader, if you're a professional trader or something, you have to know things in advance, right? Once the information is reflected, it's kind of too late. So same thing here a little bit with inflation. Yeah, sure. If you were kind of ahead of the game and maybe you were buying short term just for the year of 2020, yes, you captured all that upside of, Arizona prices spiking super much, but that's it. It's done. From this point on, it's already just overvalued. It's something that's going to correct at some point. So it's too late. It's just my perspective as far as looking at it as kind of trading the market. And so that's a comment on inflation, because, I'm myself primarily invested in real estate. I used to own stocks. I don't own any stocks now. I fully switched to real estate and cryptocurrency, and I even sold my cryptocurrency. So it's kind of, for me, I'm happy for it. It's just I feel that it's a very short horizon that you are going to benefit from in this way, and then down the road, okay, you just have you're in an overvalued market or overvalued asset, and you kind of start thinking about what to do and an exit strategy, etc. So
yeah, I was just sitting here thinking about, like, specifically, I live in Utah, obviously, so I have some expertise there. I am a residential real estate agent, although I don't really do that anymore at all. But when we're talking about overvaluation in these different markets, like let's take Boise, for example. First of all, is that a measurement? Go ahead.
Just to say, Boise is the most overvalued city in America, because we mentioned no city so far. We also know, like, if you listen to Neil Bawa, it's the city that performed the best. It's both the best performing, but also most overvalued. So Idaho, like you mentioned, is very overvalued, and Boise is the most overvalued place in Idaho. And it's been crazy in Boise, and I think it's a bubble. And eventually, but yes, go ahead. Sorry.
Well, that's what I was getting at. Is it a bubble? And the reason I asked that is because I know Utah. I don't know Boise very well, but Boise has a lot of similarities to Salt Lake City, where I am, in terms of demographics and demand, especially. So what we've got in Utah is this a very large component of people moving into the state from outside of the state, specifically from the coast. And there is just a huge demand factor that it's really hard to ignore. We're building as fast as we can. Everywhere you look, there's cranes and mid-rise apartment buildings going up. And from what I hear, even if those were all to be completed and filled today, we would still have a huge shortage of available housing in Utah, which, to me, as a lay economist, if you will, says that if that supply and demand factor is still there, that it's hard to argue maybe that there's a bubble, so to speak.
Yes. I understand. I agree. I mean, this is the kind of strong market argument, right? It's a market that is booming. I mean, if you look at, let's say, before the global financial crisis, like the states that were the most booming ones were Florida, Arizona, Nevada, and California at the time. And they ended up the most overvalued, and the population in Nevada was exploding. So in the state of Nevada, population between 2000s and 2019 and 19, let's say, approximately 20, right? So for 2 decades, increased by 50%. So the first 20% or that in the first decade, and then subsequently. So the fact that population was booming so much in Nevada did not prevent. It's a relative measure, because if you say, let's say Boise, so if you say, okay, because they have a housing shortage, they have lots of development happening, but again, housing shortage gets reflected in that, we can, because they do like this simple measure by affordability, but I can do it by, one can do a multiple regression of everything, right? You can include housing shortage, you can include population, you can include incomes, okay? As you include those and you approximate what you think the prices should be, if Boise is above this level, that is where the overvaluation comes from. And there is no denying to Boise being the very strongest market this market cycle. Out of 800 cities, it has performed the best. So 800 cities, the biggest price appreciation since its last fair valuation. But it happens to be overvalued. An example against its fundamentals, again, which are income, population, housing supply. An example opposite to that is Denver, by the way. So that's a good example, because I like to look at these kind of nuances. So Denver, for example. So that's if I was living in Denver and I'm not computing this stuff, I would be thinking this place is crazy overvalued. Prices are going through the roof. Prices go up and up and up, almost comparable to Boise. Denver is also from 800 cities is probably top 10 or something. So, or definitely from the top 100, it's top 5, so Denver is one of the strongest markets this cycle. And Denver, now before this whole inflation happened, I don't know what are its numbers right now, I don't remember off the top of my head, was fairly valued. So I was speaking for my webinar at the beginning of COVID, and I was sharing, okay, Denver has had this incredible appreciation, and it's at 0%. Apparently, all its fundamentals are in place. And that's it. It's just kind of hard to, we cannot intuitively or compute in our head. We cannot know how the fundamentals have moved to know, is it overvalued, is it not? It doesn't need to be, to your point. If Boise had appreciated a little bit less, then it could be maybe fairly valued. It just, my intuition for Idaho is, and looking at that, it seems to me statistically valid. I would be surprised, if it's not, in the sense, if you again, and the other thing is, if something is overvalued, doesn't mean it's even going to correct. It's just that in the global financial crisis was a correction scenario. So it doesn't mean some kind of doomsday of sort. It's just to recognize downside risk, right? So let's say in the global financial crisis, it happened to be a big correction scenario where everything corrected. I had some statistics from 3,000 counties. I believe 80% of them experienced a correction, where let's say correction was defined in some way. I don't remember the exact definition, this percentage drop in a certain time frame, et cetera, et cetera. So 80% of counties in the US experienced a correction. So global financial crisis was, broadly speaking, a price correction scenario. It doesn't mean it's going to be the case, because, for example, you can have a situation where prices just become more stagnant kind of over a long period, and the incomes catch up, and just it never even corrects. It's just going to kind of reflect in less appreciation in the future, in theory. Now, I don't think in the real world, most of the time it ends up like that. It seems that most of the time correction is what happens, but in theory, it could be that stagnant prices is the other scenario. Or the third scenario, it could be that even prices continue to be strongly performing, but let's say incomes or other fundamentals experience super growth, and then they kind of catch up, just because fundamentals really catch up. And to be honest, at this point, some of the income super growth is possible, because if we think of at the current point, prices, like I mentioned, let's say in Arizona or other places experiencing such high appreciation this year, well, incomes haven't. And so maybe it's possible that they do as well. And maybe I'm actually hoping that some of those valuations settle down a little bit, or their longer term over the next 2-3 years level is a bit less. So if we're seeing Idaho in this kind of very high overvalued territory, I would expect that maybe they would settle. They were 25% before, and now they sharply jumped. Maybe they would settle kind of to 48, right? So they would kind of maybe settle in between, to maybe 35 or something like that. So this kind of a potential scenario. So yeah, things don't need to correct, but it's just something to be aware of. There are states, again, which are undervalued. They're more undesired, but places like Indiana, Ohio, Kentucky seem very, very much a better decision right now at this moment.
Yeah. And, Indiana has one very hot market in it, in Indianapolis. And
yes, true.
It keeps doing better and better and better, and both in the single family and the commercial world. Kentucky's got Louisville and Lexington in particular.
True.
Both are markets that are healthy and college towns and have some really nice fundamentals with them. So let me kind of cut to the chase here, since we're kind of along this line.
Yes.
I don't mean to put you on the spot, but are there any particular, what are you excited about at this point? You're an investor, I know, and you've got your own portfolio. Are there any particular standouts right now that you're excited about?
In terms of markets?
Yeah, in terms of markets. Side? Yes. Yeah. Markets. Yep.
Yeah, I think in terms of markets, I think it's going to be the time for, or also properties, it's going to be the time, I think, for kind of value add. It's been already the time for value add, but kind of I call it arbitrage in finance, kind of inefficiency strategies. So it's going to be the time for flips and, short-term equity gain strategies, buying a commercial asset in some of the markets that one knows are undervalued, and then that asset itself being undervalued, obviously. having some discount or like value add component, improving it, raising valuation, like selling it within 2 years, and knowing that that's going to happen in a dynamic where, undervalued states, they're not going to drop. So people really, if they want to be protected, if you invest in a state that is undervalued and then your county happens to be undervalued, so it's extremely unlikely that you're going to experience anything material. It's going to be like a 4% drop is what happened before. So it's, again, your specific county, you can also be hit by something very topical, right? Your population moves out of there for some reason. But those are like already hard to predict things that you would not be able to measure either way. And so that's what I'm excited about, is arbitrage, inefficiency, short-term equity gain strategies in I would say that the Midwest and Northeast would end up being now. I was excited. I would love to do them in Florida. Unfortunately, it seems I'm going to have to wait a little bit.
Yeah. Cap rates in those areas are pretty compressed right now. So, Well, Stefan, this has been amazing. We could go on for a while here. I'm learning a ton as we speak, but unfortunately, we're running out of time. But I do want to mention RealtyQuant again. I've spent some time on it. You have a course that starts on January 15th. Of 2022. Correct. And this episode will be coming out sometime in mid to late December. So, so listeners, go to RealtyQuant.com, and that's Realty QUANT.com, and then click on the Academy tab, and you'll see his course. You'll see Stefan's course on data-driven real estate investing. Where you're going to learn data analytics, financial modeling, and machine learning applications. It looks like an awesome course, and looks like it'd be for the right person with the right at the right point in their business and the right kind of mentality. This would be really, really valuable, kind of one of a kind. I've never seen anything like this before. So, anything else you'd like to say about the course?
No, thank you so much, Tate. No, that was great. And another thing is we have on RealtyQuant.com also market data. So if you guys want to learn if your county, so it's for 2,700 US counties, if you want to know if your specific county or state, etc., or like market is currently overvalued, you can go there, and we offer a lifetime subscription. It's going to be updating some of the pricing and that, but it's going to be a lifetime subscription that you get quarterly updates, and you just are calm and know, are your markets overvalued? Can you have business continuity, etc.? It's a great product.
Yeah. Awesome. Okay. So again, listeners, RealtyQuant.com. You're going to learn about how to analyze markets, how to analyze properties, how to find undervalued markets, undervalued properties. I mean, this is what it's all about. This is how you build wealth and build cash flow and everything else in this business. So, well, Stefan, thank you so much for all your expertise and wisdom. This was really dense. There was a lot of knowledge. It was a little like, I hate to use the phrase drinking from a fire hose, but it kind of was like that for me. In a good way. Like I was very enlightening, and I kind of learned what I didn't know about what I didn't know. So I appreciate that. And listeners, I hope you got a lot out of it as well. Stefan, any last parting words of wisdom for the listeners? Put you on the spot here.
Great. It was awesome meeting you.
Yeah, it was great talking. And like I said, very informative, and really appreciate it. You've got a really cool little niche here in RealtyQuant, and I hope that lots of people take advantage of it. So on that, listeners, thank you for listening to another episode of The Apartment Guys. Hope you got a lot out of it, and we will see you on the next one. Take care, everybody.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.